Hi everyone. This video accompanies the lecture I gave yesterday at Bedford Library. It was the first installment of the Rocky Retirement Series that gives practical advice and information about how you can invest for retirement using the financial market and things like stocks and bonds. It'll be posted to my YouTube account, so please feel free to review it if you want to go over some of the vocabulary and investing principles that we discussed. And also, please feel free to forward it to friends and family who you think might be interested. So let's get started. So a little bit about me. I worked for about 15 years in investment banking, primarily in stocks, but also in the bond markets. I worked in both Hong Kong and New York, and I worked in several different functions, including operations and IT and trading. So I got to see different parts of investment banks and also the different markets that investment banks participate in. And you'll see my LinkedIn information here as well as the link to my YouTube. I'll have it in the description to the video. And the goal is for you to gain the knowledge to confidently invest for retirement. If you give me 6 hours of your time, I can give you that information. It'll be clearly explained in plain English, and it will distill all the things that I learned during my working years and which I still continue to use. I understand that finance and economics is either boring or intimidating for a lot of people, and it's not your fault, trust me, because our school system really doesn't teach the practical parts of investing, and the financial system is very hard to navigate. I've talked to financial advisors before, and I have great sympathy for people who find the jargon hard to follow and some of the concepts a little difficult to understand. So my goal is to help you gain this knowledge and explain the details of all these different things that I think are must know for you to invest. You got this. Now let's take a look at the stock market and see some of that data. This spreadsheet here may look a little crazy, but it's actually pretty simple. So let me start explaining it. Let's assume that it's 1980 and you've just started your career and you want to invest $1,000 into a retirement account like a 401k or an IRA and use those funds when you retire. So we assume a $1,000 initial investment, and then we further assume for now that you don't put anything else, just that $1,000 for the rest of your career. Let's also assume that there's a deposit rate at the bank of 3% and a 10-year treasury rate of 5%. The deposit rate is the money that the bank pays you for your savings account, and the treasury rate is what the government pays you for lending money to it, and you lend money to the federal government by buying its bonds. And an important note is that all the figures that I'm talking about here exclude the impact of taxes and inflation. That is to say that once we do factor in taxes and inflation, these numbers will be a lot lower. So just keep that in mind. Anyway, let's get started. So let's assume you start your career in 1980 and you want to retire, let's say in 2020. Well, the most simple, the easiest retirement plan is just for you to keep that initial $1,000 in a safe at home. Let me hide these so that it's easier to look at. That $1,000 just stays in your safe and it doesn't do anything. So by the end of 2020, you have $1,000. There's no risk to that money, except in the sense that if your house burns down or gets flooded, or if someone robs your house and figures out how to crack the safe, you'll lose that $1,000. But there's no financial risk to it except for the impact of inflation, because over time, the purchasing power of our money tends to go down. And we experience this painfully, especially in the last couple of years as the prices of things going up. So inflation makes things more expensive. So that doesn't sound very satisfying. So, well, there's something else we can do. We can put our money, that $1,000, into a bank account that pays us 3% every year. So at the end of the first year, we'll have $1,030. And then that $1,030 will again earn 3% the next year, it'll be $1,061. So by the end of our working career in 2020, we'll end up with $3,360, which is not bad. It's more than 3 times what we would have made if we just kept that money in a safe at home. The reason why we're actually earning money here, let's think about this. Why does the bank deposit rate on their savings account? And the reason is because this deposit is actually a loan by us to the bank. The bank takes our loan and lends it to other households and businesses. And those businesses and households will pay the bank an interest rate, let's say 5%, and then the bank turns around as a thank you to us and pays us the 3% deposit rate. Now you might say, well, I want to take a little bit more of a chance. I want to get a higher rate of return than this. So let's say that I decide to invest in a US Treasury bond because, simply put, a US Treasury bond pays more than a savings account. It'll pay, let's say in this case, and I'm just making up the number here as a very, I'm just guessing at what the average would be. Let's say it's 5% for these 40 years. So at the end of the first year, after you buy the government treasury bond through your bank or your broker, you'll have $1,050. That's 5% on top of the $1,000. And the next year, that $1,050 becomes $1,103. So what we start to see here with the interest paid by the government and the interest paid by the bank, that your money compounds. The initial $1,000 is compounding at the rate of interest. So it doesn't grow that much from one year to the next, but over a long period of time, this compounding can have a very big effect. So that 5% difference, in fact, leads to more than a doubling of what you would have made if you put the money in the bank. That's $7,000. So these are relatively safe ways to go about investing. We'll talk about that later, but just for now, recognize that it's relatively easy to invest in treasury bond and to deposit your money at a bank. The main risk that you have here, of course, is that inflation is higher than the interest rate that you get paid. So if inflation is 10% or 15%, then in fact, you would have been losing money because things get more expensive compared to the amount of money that you're earning, right? So if you're earning 3% and prices are going up 10% across your shopping list, you are doing worse every year. So inflation is a big risk for people who lend money. Now, let's say that you heard about the stock market and something called the S&P 500. So you decide to invest the money in a S&P 500 ETF, and you hold it in your retirement account. And I've actually gotten historical data on how the S&P 500 did. So how would you have done? Well, at the end of the first year, you would have made about a 25% return. You have $1,257. Compare that to if you had bought a US Treasury bond or deposited that $1,000 at the bank. It's much better. However, in 1981, there was a recession. So stock prices went down, and therefore your investment in stocks would have gone down as well. So you would have lost about $100 between 1980 and 1981. Now, after that, the economy grew again, but again, a recession in 1990, a recession in 2000. If you remember, that coincided with the stock market downturn related to internet stocks. The internet bubble burst, people say, and then also the September 11th attacks in New York. So look at the dip that you took. In 1999, that $1,000 became $13,000, which is fantastic. But that $13,000 fell to $8,000 over the course of 3 years. So those 3 years were pretty horrific. Now imagine you were at the edge of retiring. You were in your 60s, and you had all your money in the stock market. You would have taken like a 40% hit to your net worth, to your portfolio. And there's no telling when your stocks are going to go back up. So you're already starting to get a sense that part of the risk you take when you invest is how much you invest and in which asset you invest and how much time you have. Because as a young person, someone in their 20s, they can afford to take this kind of downturn in their net wealth and maybe even invest more because they have time. But if you're in your 60s, you don't have time, you're more concerned with preserving your wealth than in increasing your wealth. When you're younger, you might be more interested in increasing your wealth and less interested than in preserving what you have. So you're not as interested in the cash in the safe at home or in a US Treasury bond, whereas someone closer to retirement, it's a totally legitimate thing to start to prefer those types of assets. But not to fear, because in 2003, things went up again, but we had the 2008 housing meltdown, and that, of course, hit the stock market very hard. So you would have gone again from 13,000 back down to 8,000, and it was a horrific time if you lived through that time. Millions of people lost their homes, millions of people lost their jobs. People were very pessimistic about the future. Now, slowly, you'll see that as people became more optimistic about the future, we dug out of the recession. We prevented the financial crisis from widening and becoming a true emergency. And by the mid-2000s, there were a couple of more downturns. But by 2020, you would have had $35,000. Starting from $1,000, and all you did was putting it into a mutual fund or ETF in your retirement account, bought the S&P 500 and let it ride, and you would have multiplied your initial money by 35 times. It's not bad, right? So you might be starting to ask or get the sense, well, why does the stock market go up? Why did I make money just by buying into the stock market? What does it mean to buy into the stock market? How do I do it? When is the best time to do it? And what sort of things should I be aware of? So I hope you're starting to ask those types of things now. There's a couple more scenarios that we can go through. So let's do that. Here in this new column, column J, you'll see that it's a strategy involving buying stocks, buying the S&P 500, but then you reinvest dividends. In the previous scenario, we did not reinvest dividends. So what does it mean to reinvest dividends? Well, when you buy shares of stock of a company, that company will pay you dividends. And buying shares of the S&P gives you access to these dividends. So it's kind of like if you own a coffee shop, you're the owner, and then you hire a manager, and every month when the coffee shop makes a profit, they'll say, okay, your share of the profits after all the expenses have been paid is X amount of dollars. Please let me keep some of it to reinvest in the store, to improve the signage, to get better furniture and drinkware. And then the rest of it I'll pay to you as profit. That profit is your income. That profit is the savings of the business after all expenses have been paid, and they go into your pocket. Now, what this means is when you reinvest those dividends, you as the coffee shop owner, you tell the manager, no, keep this money that you're about to pay me. I'm going to reinvest it with you. So you pay me the dividend. I recognize it as income on my taxes, and then I invest that money back into the coffee shop. And you're doing exactly the same thing here. You're taking the dividends that the businesses of America are paying you out of their profits, which belong to you. Those dividends, you then turn around and buy more shares. Okay, so with this strategy, at the end of 1980, you would have had $1,300. You would have taken a slight dip the next year because of the recession, but let's look at what would have happened. By increasing your stake every year by reinvesting dividends, you would have made $97,000 off that initial $1,000. That's a 97 times return on your initial investment, that $1,000, without you having to do anything. This is the stock market working to make you rich as an owner of the businesses, of American businesses. This sounds almost too good to be true, right? And in some sense it is, because there were other times in American history, it's not on the spreadsheet here, but for example, the Great Depression of the 1930s, the Great Inflation of the 1970s, when stocks were an awful investment. So the key to investing is understanding how the products work, how to make use of them, and then deciding which ones you want to invest in, for example, a bank account, a treasury bond, or stocks. And then there are steps that we can take to actually improve the chances of us earning profits from these businesses, and also in terms of minimizing future inflation. So we do have the ability to improve our chances for good outcomes. Now, because finance is so confusing, it's not taught in schools, it's not well explained by financial advisors or insurance agents. Let's say that you park your money with a fund advisor, a personal banker, or a financial advisor who charges 1% of your assets every year. So this year, they'll charge you 1% of your assets. If you put in $1,000, they're going to take $10 out, and so on and so forth for the next 40 years. Let's see what happens. That 1% doesn't seem like it's a lot, but at the end of those 40 years, look at the difference. Instead of having the $97,000 having reinvested dividends, you've still reinvested dividends, but you only ended up with $67,000. That's like a 1/3 difference. And you can say, well, how is this possible? And the thing is that over long periods of time, even a very small difference in percentage points can have a huge impact. The way I like to say this is that fees are like fleas. They're like fleas because they are small, but they have a very big impact. And as Benjamin Franklin once said, a small leak can still sink a big ship. And that's very true with fees here. So we're seeing the magic of compounding, how the stock market compounds our wealth year after year. We'll study how that exactly happens so that you understand that process. But we also see that the financial system can extract a pretty heavy price for you to use their services if you don't know what it is exactly that they're offering. Because keep in mind, financial advisor has no clue, no idea better than the rest of us how the stock market or the bond market will do in the future. They can't predict that. No one really can, right? So what is it exactly that you're paying them for? So if you go talk to a financial advisor, I want you to keep that question in the back of your mind while they're talking to you, and then even ask them straight out. Like, what do you offer that the stock market couldn't do if I were able to invest in a S&P 500 ETF in a retirement account? See what they say. Ask them how they invest their money. Does a financial advisor hire another financial advisor? Which insurance agent do they go to buy their insurance? And hopefully they're straightforward about sharing that. So we see here the motivation to actually learn this financial literacy stuff. It's because once you learn how the stock market and the financial markets work, you can make it serve you, and the impact can be enormous. Just for the heck of it, let's consider what happens if after that $1,000 investment, we invest $1,000 every year for 40 years. Seems like it's reasonable, right? Well, that $1,000 with dividends reinvested plus an extra total of $40,000 would become $735,000 by 2020. If you had hired the services of a financial advisor at 1% a year, that would be $542,000. So you gave away $200,000 to this financial advisor. And again, think, what could they possibly be offering you that would be worth that $200,000? Okay, let's go on. So I asked a couple questions earlier. Why does the stock market go up? What is it exactly? What is the S&P 500? Why do stock prices go up and down? And the news will talk about what people predict in the future. So to understand stocks, we really have to understand businesses. Okay, stocks are shares of ownership of businesses, essentially. So let's take a look at a company that hopefully you're all familiar with, Apple, and then let's see how Apple did in the past. In the year 2000, Apple had sales of $8 billion. It had profits of $786 million. And its value in the stock market was $5.1 billion. 25 years later, fast forward, sales were $416 billion. Profits were $112 billion. And the value of Apple was $3.8 trillion. It's quite a difference. Let's understand what's going on. First of all, Why is Apple worth 3.8 trillion dollars? Well, the answer is simply a math equation. There are about 14.8 billion Apple shares owned by millions of investors. These shares trade on stock exchanges like the NASDAQ. You can open a brokerage account or retirement account and go to the interface of that website or your app and then buy shares of Apple, and you use the services of the broker or retirement provider to interact with the stock exchange, and then you can buy and sell shares of Apple. It's kind of like going to the grocery store, except you're buying stocks instead of food. The last traded price of Apple on last Friday, was $257.46. So all I did was multiply the 14.8 billion shares by the $257 per share, and that gives us $3.8 trillion. Apple was a miracle. $100 invested in Apple stock in 2000 is worth about $29,000 today. So if you think that the S&P 500 did well, Apple did fantastic. During that time, those 25 years, Apple paid $1,100 in dividends. So you would have made back 11 times your initial investment, not even considering the increase in stock price. And what if you hadn't reinvested those dividends like we did in our S&P 500 scenario to buy more Apple stock? Well, I don't even want to calculate that. You would have probably hundreds of thousands of dollars worth of Apple stock. So this naturally brings up a couple questions, because we all want to buy shares of Apple like this, right? So how did Apple increase profits so much? Why does Apple stock even exist? Why did the price of Apple stock go up so high? So starting with the first question, how did Apple increase profits so much? Well, it's because Steve Jobs did two things very well. Number one, he balanced stakeholder relationships effectively. Number two, he invested wisely for the future. So who are Apple's stakeholders? Well, here's a diagram. On the right, you'll see customers with a star next to them, and I put a star next to them because customers typically, in economies where people have the freedom and the right to buy pretty much what they want, customers are the most important stakeholder. And the reason is because they're the ones who buy the products that a company sells, and it's that money, the sales of that company, which help pay for all the other stakeholders. There's no customers, there's no company. There's no viable business. So everything starts with the customer, and then the other stakeholders are focused on providing the company what the company needs to service those customers. So suppliers will provide products and services. So in Apple's case, suppliers were selling Apple things like memory chips, modems, the glass for the phones, the wires, and all these other things. And also other products like music rights, which Apple provides over Apple Music, TV shows, which it sells over Apple TV, and so on. The employees are like suppliers, but they're hired directly under the company. They work for the company. So the company has a lot more rights to direct an employee than it has for a supplier. A supplier can choose to leave a company, but as long as the employee is hired by the company, they have to do what the CEO wants them to do. Of course, they have the option to leave and look for other jobs. But that's the difference between a supplier and an employee. And we see in the gig economy that actually the boundary between these two stakeholders is blurring quite a bit. So if employees and suppliers provide products and services to a company like Apple, then the lenders and shareholders provide the capital. And this is probably where the term capitalism comes from. It refers to the money that the lenders lend to Apple and to the money that the shareholders invest in Apple. So Apple pays an interest rate to the lenders as a thank you to say, all right, I'm going to borrow this money for 20 years. I'm going to invest it in my business, lowering costs, building new products. And then at the end of the loan, Apple will pay back the loan. And Apple has to make sure that it always pays what it agreed to at the time that it made the loan or that it borrowed the money. So the cost of the loan, the interest rate is determined upfront, and it's legally binding. Shareholders have no legally binding income that they are entitled to. That is to say that Steve Jobs cannot tell shareholders, I promise to pay you $1 million in profits this year and $2 million of profits next year. However, Steve Jobs is legally bound to do his best. And of course, that's a subjective, ambiguous term, but the CEO has to try their best to enrich shareholders by increasing profits. So there's no guarantee for shareholders that they'll receive profits, and they're also liable for losses. If Steve Jobs doesn't do a good enough job and he loses money, then the shareholders are on the hook for that. If Apple loses money, the lenders still have to get paid their interest, employees still have to get paid their salaries, suppliers still have to get paid their invoices, customers still have to receive their products. So shareholders here are last in line for any money that's left over after everyone else gets paid. But in return, they have a lot of power. So not only do they get the profits, which lenders and suppliers and customers are not entitled to, employees are not entitled to either unless they own shares of the company, but they also have the right to elect a board of directors. What is a board of directors? Well, these are folks who do not work for Apple, but they are paid by Apple. They, in fact, work for the shareholders who own shares in Apple, who bought shares on the stock market, people like you and me. And the job of the board of directors is to oversee and monitor the performance of the CEO. So if the CEO is stumbling and they're not doing a good job or they're upsetting other stakeholders, the job of the board of directors is to remove the CEO. And they have the power to do this. If they don't do it and the shareholders get upset and say, look, you're not doing the job I elected you to do, then shareholders can vote them out at a shareholder meeting, typically. Not always, but typically. So shareholders not only have the right and the responsibility for profits and losses, but they also have the power to remove the CEO via the board of directors if they become unhappy with the profits that they're receiving. Now, it's the board of directors who hires the auditors. So not only do the board of directors look over Steve Jobs' shoulder while he's making these decisions about how to run the company, but the auditors are also double checking his books. They're making sure that Apple's finances are in order, that they're not making up receipts and payments, and that the profits that they're reporting to investors is in fact accurate and efficiently compiled in a timely way, that they're doing a good job following regulations, and that they're doing a good job stopping fraud. The auditors report to the board of directors. They don't report to Steve Jobs. So shareholders have a couple of points of leverage against the CEO to make sure that the CEO does what they want them to do. Finally, we have the government. And the government is, at least in America, not the most important or the most powerful stakeholder, which means that it leaves room for other stakeholders to express their opinions and also to make money. You can see in other economies like Europe and especially in China, where the government is the most powerful stakeholder. And it's a much different economy and a much different stock market that they have over there. Now, the US is going toward that direction. I think people who follow the news, you can see how powerful the government is getting. It doesn't seem to matter who's in power. But once the government starts to exercise its priorities, it can typically overwhelm the interests and the preferences of the other stakeholders. So that's something to keep in mind. But in this scenario, obviously, the government has an interest because everyone else gets money out of Apple and the government gets taxes out of Apple. Okay, so why is this important? Well, if you understand this model, we can make a couple of we can draw a couple conclusions. Number one, it's competitive. Number two, it's also cooperative. So these stakeholder relationships are a tense combination of competition because everyone wants the biggest piece of the pie, and cooperation because everyone benefits only if Apple does well. If Apple goes bankrupt, everybody suffers. If Apple does well, everyone does well. So it's a balance for Steve Jobs to make sure that each stakeholder is happy. Doesn't mean that he needs to give in to every demand. He can make customers extremely happy by charging very low prices, but then he can't pay top suppliers, he can't hire top employees, he can't pay a good rate of interest to lenders, and he won't pay a good rate of profit to shareholders. So on the other hand, if he charges very high prices to customers and very low prices to suppliers and skimps on wages, well, eventually that's going to hurt the company. So in the short term, he can make money, but in the long term, the shareholders will suffer and they won't like that. So it's interesting that in this scenario, the CEO, Steve Jobs, he's the only one that sees the full picture, right? Because the suppliers don't know really what the board of directors are doing. The lenders really don't care what the shareholders want. In fact, they're competitive, right? Because the lenders want the highest rate of interest, but the more interest that gets paid to lenders, the less profit that gets paid to shareholders. Lenders are also competitive amongst themselves. Think about people like you and me who want to lend money to Apple. We want to have the highest interest rate possible, but there might be other lenders out there who are willing to undercut us, right? Customers are also competitive and cooperative. Customers compete with each other. For example, think about holiday shopping and Christmas and how the shelves really empty out. Good deals are hard to hide from shoppers. At the same time, customers cooperate. There's reviews that customers share to alert each other about companies and products that others should not buy. They also join together in cooperatives sometimes to throw their money in together to buy things at a cheaper rate. For example, companies, when they buy insurance, they might do this, right? So it's very dynamic, very noisy, it's argumentative, and we should take that as a sign that it's being healthy because people are trying, every stakeholder is trying to do well for itself. If everything's quiet, if there's no disagreement, that's actually possibly a sign that something's wrong, that something's preventing stakeholders from expressing their preferences. And the last point on this, the reason why Steve Jobs needs to do this is because it's only if he has good control over this network of stakeholders that he can then get Apple to move in the direction of competing with competitors. So Apple has competed with and beaten a lot of competitors in a lot of different industries over those 25 years. And Apple could not have done that if Steve Jobs was not let's say, a great general leading different functions, different stakeholders, unifying them under the banner of self-interest, but getting them to give their best effort, their most honest effort at making sure that Apple succeeds and balancing each of the stakeholders for the benefit of ultimately the shareholders. So it's not easy being CEO. So to summarize, profits are the savings of companies. Now, remember, we invested $1,000 into the stock market, right? That was our savings. The profits of companies are the savings of companies. Shareholders earn profits only after all other stakeholders get paid. We're also responsible for losses. If the losses are too high, eventually the company goes bankrupt, and we as shareholders, as owners of the business, will lose the money that we invested. Shareholders are the owners of the companies. Just like that example of the coffee shop where I was the owner. So CEOs can pay dividends or reinvest profits back into the business. And it's the decision of the CEO to say, how do I invest the money that I've earned out of my savings so that I can compete better in the future? So companies beat their competitors by selling cheaper or better products. It's just a plain fact, right? To succeed, companies must maximize profits today and then invest those profits wisely. Copying competitors usually is not good enough. You have to think different. A great CEO is a great investor. Steve Jobs was a great investor, as the results show. This is not too different from an NBA team, if you think about it. If you're an owner or general manager of an NBA team, you're looking to balance all the stakeholders, the athletes, the coaches, the scouts, the owner, the doctors. You want the best team possible to go out there to compete. And year after year, you have to constantly refresh your strategy, constantly re-examine your assets, constantly look at which players you have, which ones you want to draft, which free agents you want to sign. And you have to make sure that you're doing something that's different from your competitors without actually copying them, because if you're copying them, you might not beat them, right? So it's by being innovative and being productive that gives you the best chance of beating your competitors and winning the championship. And it also goes to show that as an investor, when we invest our savings, what we're actually doing is entrusting the CEO like Steve Jobs to invest our savings for us. And Steve Jobs can say to us, look, trust me, I've earned $786 million of profits for you in 2000. Let me keep it. Let me invest it in future products that are cheaper and better so that I can go after companies like Hewlett Packard and Compaq and even Microsoft and Nokia and BlackBerry, and I'll beat them all. In fact, that's what he did. So being a good investor is partly about recognizing good CEOs because the great CEOs are also great investors. It's exactly the same mindset that we have when we invest our savings. So specifically, how did Apple increase its profits? Well, Steve Jobs did take Apple's profits year after year, retained a lot of it, and in 2000, Apple manufactured only three products. They were the Power Mac, the iMac, and the PowerBook. Some of you may not even recognize them because they're not even being sold anymore. But he wrung $786 million worth of profits out of these three products. And from there, he released all these other products, the iPhone, the Mac desktop, laptop, iPad, the watch, the TV, Apple Care, Apple Pay, Apple Card, etc. Now, what's really impressive about this is that each of these products has its own network of stakeholders. Think about how different the stakeholders are for Apple Music versus Apple TV versus the iPhone versus Apple Pay. There are all sorts of, there's banks involved, there's music companies, content creators, there's highly technical companies like NVIDIA and Qualcomm for the iPhone. And he's dealing with different contract manufacturers, different part suppliers. He's got different parts of the company organized into different departments of employees. It's a tremendous, tremendous balancing act that Steve Jobs did because he's the only one who's responsible for seeing the whole picture and making sure that the shareholders benefit. Because why would I want to buy Apple shares if I could buy Google shares or Facebook shares? He's got to give us a good reason to buy his shares and hold on to his shares. And he absolutely did that. So why does Apple stock even exist? This is a concept that maybe if you're not familiar to finance, it's a little hard to grasp. Stock is really the way you want to think about it. It's a promise to pay future profits to owners. Bonds is a promise to pay future interest to lenders. So stock is really a promise that Steve Jobs is saying, you give me your money today and I'll give you profits from the investments I made with your money by selling products to customers back to you as a thank you in the future. So in fact, Steve Jobs and his co-founders created Apple shares when they founded it, I think in 1977. Then because they didn't have profits as a startup, they sold shares to investors to fund their business. And this is exactly what Jeff Bezos did when he was selling books out of his garage to start Amazon. And it's what Michael Jordan did when he became a marketing spokesperson for Nike because instead of paying him in cash, Nike offered to pay him in stock. And so Michael Jordan became owner of Nike shares, and it was mutually beneficial because as Air Jordans started to sell, because Michael made a name for himself, Nike's profits went up too. So it's sometimes popular and understandable to say that stocks is a zero-sum game. If I sell you stock and you buy stock from me, one of us loses, zero-sum game. But think of it from this perspective. Between Nike and Michael Jordan, who lost? They both won. And the reason why the stock market keeps going up and why it has existed for hundreds of years is because half the people are not getting ripped off. Because if half the people are getting ripped off every time, if it's truly a zero-sum game, it would have gone extinct. And the fact is that Michael Jordan and Nike said, I prefer to pay you stock more than I prefer to pay you in cash. And Michael Jordan was willing to accept that. And he took the risk that by foregoing cash, he was going to get future profits. Very smart move from him. It's not a surprise that he's shaking up NASCAR now, right? I mean, that man has some business savvy. He's had two very different but very successful careers. And And so, yeah, startups will sell shares to investors to fund their business because they don't have profits, but they promise future profits. And then investors like us will say, all right, we value the possibility of future profits more than the cash we have today. So we'll give you our savings, you invest it, then you give us future profits. And it's worked. Apple's board also gives shares to employees as compensation, just like Nike gave shares to Michael Jordan. So question number 3, why did the price of Apple stock go up so high? Why did it do so amazingly well? And the answer is investors continually underestimated the ability of Apple to outsell competitors and generate profits. If you think about the fact that Apple was worth $5 billion in 2000, well, what does that really mean? What that means is that investors in 2000 thought that Apple was going to generate $5 billion worth of profits for the rest of its life, however long that may be, 30, 40, 50 years, $5 billion. Now, as time went on, stock investors like, oh, shoot, that $5 billion is too low because its profits are continually going up and up and up. And so every year or over time for 25 years, investors continually guessed wrong about how much Apple was going to generate in terms of profits. Now, Apple is worth $3.8 trillion today. What that means is that anyone who buys the stock today is anticipating that Apple is going to make $3.8 trillion of profits or more in the future. And if people start to perceive and expect that Apple is going to make more than $3.8 trillion, then the stock price will continue to go up. And that's exactly why the CEOs are under so much pressure to constantly increase profits and make great investments, innovative investments that create better and cheaper products. The pressure is unrelenting. Not too different from an NBA owner who has to constantly think, as I said, about draft picks and free agents and coaches and, where do I build my next stadium and things like that. Now, we have to stop here and say, is this reasonable? Now, $3.8 trillion is a lot of money, right? And Apple is not the Cinderella story that it was in 2000 when Steve Jobs came back for a second time and people were literally laughing at him. They were mocking him to his face. In fact, we see that this is kind of a human phenomenon, that our biases are so deep and inaccurate that sometimes greatness isn't obvious. If you consider the fact that Lady Gaga got dropped from her first record label, right? 3 years later, she's on a worldwide tour for the fame. And if you consider how Tom Brady was drafted in the 7th round with a couple of quarterbacks selected ahead of him, even the experts can make mistakes about who the future winners are. So is Apple still, having been a past winner, are they a future winner? Well, let's look at some history. And this is great data that I got from, well, he didn't give it to me, but I pulled it from one of his annual meetings. This is a list of the 20 largest companies by value. He calls it market cap or market capitalization. But these are the 20 largest companies, most valuable companies in 1989. So this is going back like 37 years or something like that, almost 40 years. If you look at this list, you'll see that the largest company is about $104 billion. And the top 4 companies are all banks. Not only that, but they're all from Japan. And then there's a bunch of other industrial companies from Japan lower down on the list. And we have a few US companies like Exxon, General Electric, AT&T, Philip Morris, and Merck. So there are 6 companies from the US and 14 from other countries, and it's dominated by Japan. Now, who are the 20 most valuable companies today? Well, let's take a look. Pardon me while I get to the site. Okay, here's a site called Companies Market Cap. Well, the list looks quite different. First of all, the size of the companies is enormous compared to the 1989 list. They start with NVIDIA at $4.5 trillion. And most of the top companies are not Japanese, but they're American, and they're not banks, but they're tech companies. And there's a bunch of the usual suspects, Facebook, Broadcom, and Tesla. We see here two non-US companies, one from Taiwan, Taiwan Semiconductor, and then Saudi Aramco, the national oil company. And then we see Berkshire, which is Warren Buffett's company. Um, and they're based in Nebraska. We see Walmart, a retailer. They're based in Arkansas. Eli Lilly Pharmaceutical. They're based in Indianapolis. So as we go on, we see a couple more companies, JP Morgan. ExxonMobil is actually the only company from 1989 that's still on this list in 2026. And then we see Visa, Johnson Johnson, and another tech company called ASML. So that's the top 20. And if we go down further, we'll see it's heavily dominated by US companies, and Chinese companies only appear down here in the 30s. And interestingly, they're all banks, similar to Japan. So a couple of other things that we can notice is that although the top companies are tech, as we would have expected, they're relatively new. Like, for example, NVIDIA didn't even exist in 1989. Jensen Huang founded it in the 1990s out of a Denny's restaurant. Google did not exist in 1989. Amazon was founded, I think, in their mid-90s. Facebook, founded out of Mark Zuckerberg's dorm room at Harvard, I think in the 2000s. Tesla, of course, started in the mid-2000s as well. So we see relatively new companies, companies that didn't exist in 1989, with young founders. And then we see after that quite a broad range. It's not just concentrated in tech, and it's not just concentrated on the West Coast. So this might be a sign that the economy is pretty healthy, that companies are rejuvenating, that dominant companies are not staying at the top, that they're constantly being refreshed. And it's not just in one location. There's people in multiple locations who are extremely successful, so that power and decision making is not concentrated in one geographic region or in one industry or in one generation, right? So why am I sharing this, and what can this tell us? Well, let me go back to the presentation. The reason I'm sharing this is because, as we discussed with Lady Gaga and Tom Brady, sometimes greatness isn't obvious, and it's true with companies too. It's hard to predict who the winners are going to be and who the losers are going to be, because some of the future winners, if AI and robotics and space exploration and quantum computing and 3D printing and biotech, if all these things take off, or some of them take off, the future winners may not even exist today if you look over a 40-year period, right? So that's something we just have to live with if we want to invest. Competitive outcomes are very hard to predict. If you think about how hard it is to predict the winner of a Super Bowl or the winner of a presidential election, right? Fair competition is very hard to predict. And that's why investing is risky. It's because the future is uncertain. And that's why people find investing stressful. Because not only is it not taught in schools, and not only is it not explained well by most financial advisors and personal bankers, but it's because we have to go through the misery of saving money and giving up shopping today, which we love. And then investing is something that may not work out, right? On the other hand, if you remember the spreadsheet, some of those gains were extraordinary, right? So we're conflicted. We want to invest, but we want to be assured of good outcomes. But unfortunately, that's impossible. So investing is risky. There's no guarantee that you'll get good investment results. There's no guarantee that the future economy will be good. We can take steps to make sure that the economy is strong. but it's not a guaranteed thing. So beware of any product that seems to convey a sense of ease and a message that some sort of payoff is guaranteed. It is not guaranteed. If you look at the legal fine print, they'll admit it's not guaranteed. So I wish those firms, you know who you are. I hope you really should stop marketing it that way, please. So stated simply, I've thrown a lot out at you. Let's take a step back and summarize. Apple's business is not that different from a neighborhood lemonade stand or a sports team. So anytime you hear something complicated about a company like capital ratios or EBITDA or one of these weird jargon terms, just go back to the idea of a cafe, a lemonade stand, or NBA team. Okay, they all have the same characteristics. If you think about it, the owner of a rental property is also like a CEO. So if you own a rental company, uh, then you also have equity that you invested in your home. You also may have borrowed money from a bank. That's your debt. You're paying an interest rate as a thank you to the bank for the loan. And you also have suppliers, you know, people who might come by and do the plumbing and electricity work for you. You have a tenant who's paying you income. You have a government that's charging you property tax and income tax and potentially capital gains tax. So you also have to make decisions with the income you make from your tenant. How much do you want to receive as profit and how much do you want to reinvest in maybe building an addition to your home or remodeling or renovating, fixing stuff up, and getting different types of insurance, right? So you're also thinking about how to make your property more attractive so that you can get better income in the future, and by getting better income in the future, raise the price of your home. So if you are earning $10,000 and the value of your home is, let's say, $300,000, you want to try and make the decisions, first of all, by buying a good property in a good location at a good price with reasonable mortgage terms. But you want to make decisions that then increase the amount of income you can make in the future, and that increased income will get noticed by other investors and they'll be willing to pay a higher price for the home. And in that sense, you and Steve Jobs are very similar. And of course, Steve Jobs has passed away, but taking his place is another great CEO, Taylor Swift. I think it's safe to say that she's the kind of CEO that every CEO aspires to be. Beloved by her, I don't even want to call them customers, they're fans, right? Beloved by her fans and very, very good at managing her business and reinvesting into future products, well, future music. So let's start to summarize. In the next class, which is next Tuesday, March 17th, 6 p.m. at Bedford Library, St. Patrick's Day, I will explain how the stock market works. So here I explained how Apple works, and we talked a little bit about how the stock market did. The stock market was pretty excellent, but Apple was phenomenal. So I'll explain more about how the stock market works and what this S&P 500 is. I'll also do a demo of my Robinhood account so you know how to go in and type in with your own hands how to do a buy and a sell and how to look up tickers and stuff like that. I also want to emphasize, because I can't emphasize it enough, that we have to minimize fees. This is how most of the financial system makes money. They don't take risk like we do. They charge fees. Fees are like fleas. They may look small, but they have a big impact. So every time you see the word for fee, and it's not always obvious what the fees are, but when you see the word for fee, remember this picture. Okay. And beware debt, because we can compound our wealth. We can also compound our debt. Debt destroys wealth. So excessive borrowing is dangerous because it can lead to unpaid debt. Unpaid debt accumulates interest. Accumulating interest compounds debt. Compounding debt destroys savings and can lead to bankruptcy. And this is why the student loan crisis is such a sad story. It's because students were convinced to borrow excessively relative to their likely future income potential. And no one took them through the numbers, because if someone did take them through the numbers, they'd realize how much they were giving away in terms of their ability to build wealth through the stock market, because they have to pay this rate of interest to the lender. So in this scenario, the lender has concentrated a lot of power. And we can ask how they did that. Obviously, universities charging sky-high prices was part of it. There's other factors involved too. In fact, the student loan market and the mortgage market the housing market are pretty similar. And I'll talk about that in the future. But for now, I don't think, see, one of the reasons why I think people have trouble saving for money is because they're not aware of what they're giving up. They're not aware of how kind they can be to their future selves when they retire, when they're older, when they're vulnerable, right? $1 today can go very far if it's invested properly and if the economy is possible. When you accumulate debt, you're going in reverse. You're going into negative territory. And I think if people, especially young people, understand how compounding works and how the stock market is set up to serve them, if they understand how it works, then they won't need the motivation to manage their finances properly. They'll just do it because they'll have the incentive. Right now, people who struggle to save are probably people who don't see or recognize the stock market as a viable investment, right? So instead of telling people, oh, you got to work hard, you got to study hard, you got to save a lot, you got to live frugally, well, that's misery, right? We should be able to live the lives we want, and because you don't need to save a lot and invest a lot to have fantastic results, right? And sometimes if you invest too much and things don't go well, you probably overdid it, okay? We'll discuss that more. So this all leads to one of my final points. Well, people often ask me, what stock should I buy? What mutual fund should I buy? And unless I know them very well, it's very hard to recommend anything. Because the most important thing when you're investing is to know yourself as an investor. Are you willing to commit the time and effort to learn finance and economics? Because if you are not, it's riskier because you won't be able to spot the fees. You won't be able to spot the funds that underperform. And it's dangerous because you don't know, right? Someone can tell you, or you can read somewhere that something is a great investment, but if you don't know what your priorities are, and if you don't know the basics of investing in finance, it's very hard to evaluate. And then there's another subjective factor. Can you handle the risk of investing in stocks? Remember the spreadsheet. Once a decade or twice a decade, if you think back to things like 2008, the housing meltdown, and then COVID in 2020, the stock market fell a lot. And there was no guarantee that this COVID situation would improve. There was no guarantee that the housing market would have stopped melting down in 2008 and 2009. So when you invest, you have to be aware that you might temporarily lose money, and through bad luck or bad decisions, you can permanently lose money. And so the sign that you may, it's easy to invest when things are going well. And we maybe feel motivated to save and invest as we get older. Certainly the tax law is set up that way. But does it make sense to start investing more aggressively in your 50s and 60s? The answer to that can be yes or no, depending on what appetite for risk you have. Now, people can be they can think that they're very willing to take risk up to the point that the stock market drops. It's very easy to welcome risk when you're doing well. It's much harder to welcome risk when you're losing money, right? So yeah, please think about what are your obligations. Do you have a family? Do you have emergency money saved away? What are your retirement expectations? Do you have parents that you may need to take care of? Do you have life insurance? Can you afford to not work for 6 months? I would recommend you have to think about securing yourself as well as possible before you think about risking your savings, even in things like bonds and stocks. Okay, so the main thing is it's totally legitimate to refuse to invest in stocks, as long as you do it with information and not just out of bias, right? I think that's totally fine. But what I hope one of the things that happens from you watching this is that you just don't sleepwalk into your retirement because I'm 52 now. I still clearly remember when I was 22, right? Uh, Retirement time will come before you know it. So use, especially if you're young, use your youth to your advantage. The time to invest and take chances is when you're young. There's that saying, the time to fix your roof is when the sun is shining and not when it's raining. So I want to play this video for you, not to scare you, but just as a reminder of how things can go if you're not really um, paying attention.
My name is Juanita Dykes. I live in Full Retreat, Virginia. I've been retired for 6 years now. I've had a number of jobs. I've worked in factories all my life. Unfortunately, I didn't listen to people tell me that I needed to save for retirement. I thought I would get paid by the government. You'll have enough to live on. You don't. I get $1,574 from Social Security. I get $631 from my pension. You pay all your bills, car payment, all your utilities, all your insurance, all that together. It just don't add up.
Americans aren't saving enough for retirement.
I don't have no savings. I'm, I'm probably in the red at the bank before you write a check and then you don't have nothing to cover it. Then when you get your next check, all that extra money comes out.
The median retirement account balance for
Okay, so it's a sad testimony, right? But I played it so that to kind of drive home the point that we're not just talking about theories and numbers here, right? This is real life. And I'm grateful for that person who shared her life experience, as painful as it may be, because it's a story that happens millions of times. So let's see if we can start to make progress. And part of that progress is by gaining the financial literacy you need to learn how to invest. If it's not stocks, let it be bonds. If it's not bonds, let it be something else. There's many ways to get to the goal line, but the most important thing is don't sleepwalk into retirement. Starting from next Tuesday and for 5 more sessions, these are featured topics. So I'll explain the S&P 500. I'll talk more about stocks and bonds, 401k versus IRA, mutual funds versus ETFs, something called the custodial IRA. So if you are the parents of young kids, I strongly advise you to check into that. That's like the third session on March 31st. I'll also talk about life insurance and annuities, health savings accounts, college savings accounts, Social Security, and also a discussion about how AI may impact us for good or for worse. And that's the schedule. That's the Zoom link. I'll put these in the description too. Thank you. I went through a lot. Knowledge is power. Be powerful. See you next time.